The Bank of Montreal is trading at a current PE of only 13.9. Better yet, they have a dividend yield of 5.3%. But are they a buy now with the stock down 6% over a year? In today's video, we'll analyze BMO through their business operations, key fundamental metrics, and technical analysis to determine if now is the right time to buy. Bank of Montreal is the 8th largest bank in North America by assets under management, totaling 1.29 trillion Canadian dollars, or 940 billion USD as of their 2023 annual report. By net income, their largest business segment is Canadian personal and commercial banking, or P&C, at 40% of net income, followed by U.S. P&C at 30%. Next is capital markets at 18%, which is also lending focused, and their smallest business segment is wealth management at 12% of net income. So they are primarily a lending institution, as you might expect. I typically cover pros and cons in my stock analysis videos, but BMO would be a timely investment, and I wanted to produce this video while the stock is down. So let's get straight into their financial metrics, starting with revenue on a non-per-share basis. On the right, we see their revenue has been generally consistent and growing steadily since 2014, going from 17.7 billion Canadian dollars as of 2014 to 31.7 billion as of the trailing 12 months, giving them a 10-year average growth rate of 6.5%. Which is actually lower than their TTM growth rate of 13%. And a recent growth is always good to see, especially these days with so many companies struggling. Now we see their earnings per share on the left, which again is consistently growing. If we drew a point from 2014 to the last 12 months, with a notable decline of 18% in 2020, followed by a growth surge in 2021 of 68%, which gives them a 10-year average growth rate of 8.2%. Which is significantly higher than their TTM growth rate of negative 13%. With most companies, you can look at cash flow per share, but with banks, EPS is the more accurate way to visualize income. Now we see shares outstanding on the left, and there's a red flag. They've increased their shares outstanding since 2014 from 648 million shares to 723 million shares, which is a raw percentage increase of 11.6%. Worse yet, their shares were more or less steady until 2022 when they spiked and have continued to grow in recent years. Although, as we just saw with their EPS growth, their per-share metrics are still moving in the right direction. In this section, we typically look at debt to net income, but since a bank's assets are considered debt, we can't utilize this method to get a sense of financial stability. Here we see their dividend payout ratio based on EPS on the left, which has been a 10-year average of 44%. Which is significantly lower than their TTM payout ratio of 55%, potentially indicating some challenging times for BMO. And according to the platform I'm using, Simply Safe Dividends, below 40% is the preferred threshold for banks. Although I don't know how that percentage is determined, and compared to other companies, 40% is a relatively low payout ratio. Now we see their dividend history in Canadian dollars over 20 years, which has been growing consistently, but not quickly. By a 10-year growth rate of 4.6%, a 5-year growth rate of 8.2%, a 3-year growth rate of 10.3%, and their TTM growth is a modest 5.7%. The next metric we see is the uninterrupted dividend streak of 195 years, which is just insane and speaks to the residual power that banks maintain. Just for reference, Abraham Lincoln hadn't even become president yet and was only 20 years old when Bank of Montreal began their dividend streak. So although we see their dividend growth streak is only 2 years, they have shown some serious staying power. Now we see their current dividend yield is at 5.3%, which is 21% higher than their 5-year average dividend yield of 4.3%, with an average dividend yield of 4.3% and a current yield of 5.3%. This, to me, indicates a consistent undervaluation for BMO, which we can confirm through their current PE ratio, which is only 13.9, which is actually higher than their 5-year average PE of 12.8 by 8.9%. So we could interpret this as BMO being inexpensive from an objective basis, but expensive compared to its 5-year history. Or if we compare BMO to the Canadian Financial Sector ETF, XFN, the current PE ratio is at 14.2. Which is slightly higher than BMO's current PE of 13.9. Now we see BMO over a 5-year period. The first buy indication I'm looking for is an uptrend over this period, which BMO satisfies. The next buy signal I'm looking for is a below average price, which is shown by the center standard deviation channel line, currently at $102, which is a 17.7% discount compared to the current price of $84. The next buy criteria I'm checking for is that price is trading at or slightly above a meaningful support level, which it is, with this well-tested support level around $82. Although price recently broke this level in October of 2023, and if you were to look at the 52-week range, you might think that BMO isn't a great deal due to the recent low being within the past 52 weeks. But over a 5-year period, it's still trading at a significant discount. The The last buy criteria I'm checking for is that the relative strength index signal line is near the bottom of the channel, which it is currently, and it looks to be reversing. So from a technical standpoint, BMO checks every potential buy box, but it could fall to the 52-week low. It would be useful to compare BMO to a Canadian financial sector ETF like XFN, but I'm unable to analyze this ETF from Thinkorswim, and I even called Schwab to attempt to do so. If you want to see my buys and sells, check out my Patreon link below, where there is currently a free 7-day trial. Full disclosure, I'm long BMO. Thanks for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.